All right. So I hold these office hours from 7 to 8 p.m. on a Wednesday. This is really dedicated to helping my students better understand the contents of each of the chapters we'll be covering in a week. So the first week we covered chapter 1, and as I described this morning, I think what I wanted to do was bring everybody's attention to focus on two things. First of all, what you must know about the course content to be able to pass the course according to the way others have designed the course. So this is basically a highlights list for you to review and be sure you understand these concepts. So there's basically 3 concepts. In chapter 1, we talk a little bit about stakeholders. We talk about the qualitative characteristics of financial information, and we investigate the accompanying assumptions that are used by accountants as preparers of the information, using guidelines in the form of generally accepted accounting principles to try to satisfy these qualitative characteristics. So what I am expecting is that in the area of stakeholders, you may find yourself encountering questions on the quizzes or the exams that ask you to either identify stakeholders, or once maybe one has been identified for you, is to describe what their objectives might be, what they are interested in accomplishing from their connection to a business entity. Okay. And one of the key things I think is important to understand here is that stakeholders, the course ACC100 deals mostly with what's called financial accounting. There's another branch of accounting called management accounting. And as you might guess, management accounting is focused on providing information to internal stakeholders, whereas the financial accounting is based on preparing information to be provided to external stakeholders. So the external stakeholders are those stakeholders who typically provide resources to the business entity. And we went through a couple of stakeholders in class. The 2 most important ones that are providers of resources are investors and lenders. And they think differently. So one of the things I'll encourage you to do is understand how they think and how they make decisions. If you can do that, your understanding of the information that they need will be deeper. Okay. Now, the second thing I think that students should understand are some ideas that I recommend you learn to kind of deepen your understanding of how all this financial information is useful. So these are what I call insights. The stuff that's already been provided to you in the textbook and the videos. This presentation just does a few highlights, okay? But insights are kind of a reflection of what I'm thinking about this stuff. And there are basically 3 insights. There is, can we establish a business context, like a stage, if you will, where all of the stuff that you're going to be learning about financial accounting is connected? Can you hold 1 second? My dog is moaning.
No worries.
Come on. Go lie down. She doesn't like to be alone. All right, so the business context will be basically the environment that we are going to be generating information, financial information within, okay? In addition to what the textbook has provided, I have some other insights for you about stakeholders. And I also have some frameworks that are related to, I call them critical thinking questions, that you can use as a student and review these when you're learning new concepts, okay? So in the business context, I'll introduce you to the 3 fundamental goals of any business. And in financial accounting, we will deal with 2 of them, 2 which are economic or financial, okay? In addition, what you've read about in the textbook, they use the terms financial performance and financial position frequently. Do you remember?
Yeah,
But do you think you really understand what those concepts mean?
probably not.
No. So we'll get to it more deeply throughout the course, but I'm going to introduce the ideas to you tonight. And these notions of financial performance and financial position, they connect to the business's economic and financial goals. Okay, that's one of the reasons why we need to understand the fundamental goals and the financial performance and position. And then financial accounting information or financial reporting information is provided to external stakeholders who are interested in assessing certain aspects of financial performance and financial position. So we need to understand, who are the stakeholders who want to do that, and what aspects are they interested in evaluating, because those influence the decisions that the stakeholders will make to either engage with the entity or not. Okay. And for each stakeholder, we need to understand their objectives. If you remember, I think you were in this morning's class, right?
Yep.
We talked about lenders, we talked about investors, and how they had different objectives.
Mm-hmm.
So when we can identify a particular stakeholder, if we can get inside their head and understand how they think and how they make decisions and what criteria they use in making the decision to do business with the entity or not, then that's helpful for a number of reasons. One, it helps accountants prepare the information that they need to assess those criteria. And 2, if you are a manager inside a business or you own your own business and you're interested in procuring resources from these stakeholders, then it's incumbent upon you to provide them with the information they need to make the decision. If you don't provide it, they'll simply ask for it, and you want to be able to compile it beforehand and evaluate it yourself so you can anticipate how they're going to evaluate it. For example, if you prepared a statement of financial position and you evaluated certain aspects or business criteria, you might become aware very early on that your company just would not qualify for a loan. Mm-hmm. And therefore, you'd be wasting time if you went through the process to try to get one, okay? But if you understand what lenders are looking for, then you'll be able to use that information to prepare an appropriate application for a loan when the time comes. The critical thinking questions, I'll get to the elements of those a bit later on, okay? All right, so let's start with this business context. I mentioned there are 3 fundamental goals for any business entity, and I understand that the class has taken a marketing course in the previous semester, right? Mm-hmm. So the first goal of any business is basically its mission. It's to create value by satisfying a need in the marketplace. Okay. Does that sound like something you studied in your marketing course?
Yeah.
Okay. But there are 2 other goals. And these goals are financial or economic. So the first goal is for your business entity to simply survive. That means don't fail, so that you'll be in business today, you'll be in business tomorrow, and you can carry on. And so what's really important here is that your business is in a financial condition that allows you to carry on doing business from one day to the next. Because what we're really after in economic or financial goals is goal number 3, which is to generate some kind of rewards or wealth for the owners of the business. And certain things have to happen to increase the owner's wealth For example, the business needs to grow in size. It probably needs to become profitable or more profitable. And it needs to be able to generate some cash. The reason I've laid these goals out this way is I want you to appreciate that if a business fails, it can never get to success, right? If it doesn't survive every day, one day at a time, 1 week, 1 month, it never has the opportunity to achieve economic success. And what's interesting is that the management of the business for survival is a little bit different than the management of the business to achieve success. And what you'll see is that the financial information that's generated in an accounting system, some of it is used to help assess a company's ability to survive, and other information is used to assess a company's ability to succeed. You understand? Okay. So in accounting, particularly, well, both internal and external stakeholders, we focus on these two goals, and we concentrate the preparation of information on trying to provide information that's useful to evaluate survival and success. Okay. Now, I'm going to put all of what I've just said into kind of a big picture graphic. And what I'm going to attempt to accomplish here is to have you understand why stakeholders need financial statements, why external stakeholders need financial statements. So goal number 2 is the entity needs to survive. And goal number 3 is we want it to succeed. We'll define what that means in the future. And as I mentioned on the previous slide, success depends, first of all, on surviving day to day. Now, to achieve survival and to achieve success, both of those typically require resources. Resources such as cash, sometimes people. So the P here means people. The dollar sign represents cash resources or financing. You might also need information or some kind of competitive advantage. All right. So these are the resources that a company needs to both survive and succeed, and they come from key stakeholders. Who are these? Well, typically they're investors, lenders, owners, founders, managers, and I'll look more deeply at those in a moment. So if a business needs resources to survive and to succeed, where do they come from? They come from key stakeholders who have to make a decision to engage with a business entity based on their assessment of the business entity's expected ability to meet the stakeholders' goals and objectives. Okay. Now, this double green arrow here means that the dark one is the stakeholders are providing resources to the business entity, but they expect something in return at some point in the future. Like a lender expects repayment of the loan or interest. An investor expects dividends or financial gains. Okay. So one of the things we ultimately need to do is for each stakeholder, we need to figure out, what are their goals and objectives, and what criteria are they using to make a decision to engage with the business entity or not. So it turns out that all key stakeholders will use 5 primary business performance criteria. They sometimes use them, they put their emphasis on different ones, but the 5 criteria are growth, profitability, cash, liquidity, and solvency. Okay. We'll learn a bit more about what these mean in subsequent classes. So all stakeholders are making decisions to provide resources to an entity based on their assessment of these factors about the entity. So one of the things we do with financial statements is we create these financial reports to provide information to these stakeholders so that they can assess these criteria about the business. Are you with me?
Yes.
Okay. We reflect some of this information in the statement of income. We reflect other information in the statement of cash flow. Some goes into the statement of financial position, also known as a balance sheet. And the balance sheet is supported by the statement of retained earnings. So if these stakeholders want to assess these primary business performance criteria, they will go to the statement of income to assess growth, the statement of income to assess profits and profitability. They'll go to the statement of cash flows, obviously, to assess cash flow, but they'll go to the balance sheet to assess cash balances. They'll also go to the balance sheet to assess liquidity and solvency. Okay, and we'll talk more about what those mean in a future session. Now, the information that's in the balance sheet and is used to assess cash, liquidity, and solvency, this is what we collectively mean by a company's financial position. We assess the cash balances, the company's liquidity, and the company's solvency as measures of their financial health and their ability to carry on doing business tomorrow. So this is how you can see financial position is related to the achievement of goal number 2, which is survival. These financial statements, the statement of income, the statement of cash flow, as they assess growth, profits, profitability, and cash flow, they are assessing financial performance. How is your business entity performing? So that question is a little bit ambiguous, but when it's asked, what stakeholders are really wanting to assess is, are you growing? On the top line of the income statement? Are you generating profits on the bottom line of the income statement? And do you have a healthy enough cash flow that allows you to acquire more resources or pay your debts when they come due, or so on? Do you have any questions about this? Okay. Now let's talk a bit about stakeholders. So here is an identification of 9 different types of stakeholders. You can review this on your own time, but I want to draw your attention to 4 of them. So these are what I call the key players or the key stakeholders. 2 of them, which are in dark green, are what I call the big capital providers. So these are the types of stakeholders that could provide significant amounts of cash, which is a resource, to the business entities. The people who own the business are the founders, who usually become a shareholder when they start the company, and investors who sometimes come along a little bit later after the company has started up. And the significance of being owners is that these are the only stakeholders who have the opportunity to possibly enjoy significant financial gains. Okay, everyone else is engaged in transactions with the business entity at what we call cost. A lender is not an owner. A lender provides money to the business entity and they expect it to be repaid dollar for dollar. But as we talked this morning, a venture capitalist might put money in and expect to get 10 times that money back. However, they don't necessarily get it back directly from the business, whereas the lender is expecting to get repaid directly from the business. Okay. Mm-hmm. The reason the investors don't expect to get repaid from the business is they expect to sell their investment to another investor, some investor over here. Okay. So we've also talked, the textbook refers to customers and suppliers and management and Canada Revenue Agency and so on. But the ones we want to focus on are these 3 in management, and primarily the 2 in the dark green ones. Okay. Why do stakeholders matter? Well, they matter because the business entity's success, which is goal number 3, and goal number 2, the business entity's survival, they depend on the continued commitment of all these stakeholder groups. So here again is the list of 9 stakeholders. Now, every stakeholder has to make a decision of the same nature. They have to decide whether or not to engage with the business entity. So if they do, this is like the green traffic light. If they decide not to, that's like a red traffic light. Okay. And here I've just listed the benefits that each of these types of stakeholders can provide to the business entity. So, for example, investors and lenders, these are the ones who provide significant financing. Management are important human resources for a business because they provide planning for achieving the company's goals and objectives, and then executing the plan to actually achieve those goals and objectives. Okay. All right. I'm going to reduce, if I go backwards here, I'm just going to reduce this list of 9 stakeholders to the 4 that I had identified previously. I'll come back. So here are the 4: the founders, the investors, the lenders, and management. Another thing to remember about stakeholders is they're people. We might think of borrowing money from a bank, but the decision maker within the bank who decides whether your company can get a loan is an individual. And so it's often useful for us to take stock of what the personal interests of these decision makers are. So, for example, a founder, their passion is they're trying to solve a problem and create change, make something better, and this is what drives them to get up every morning. You know, investors, they have some issues with building their reputation. They may want to help the company achieve the mission. That success will improve their reputation and allow them to get more business. Lenders, basically the bank manager wants to keep their job, get promoted. If the bank offers bonuses, maybe get some kind of incentive pay, and the same with management inside the company. Now, in addition to those personal interests, every stakeholder has a financial interest, which usually has something to do with them acquiring cash. So, for example, if you start your own business, and as we discussed in class this morning, you know, you may have the expectation of wanting to double your wealth, or increasing it maybe to 5 times or possibly as much as 20 times. Investors are looking, especially in early stage companies, they're looking to make a multiple of their investment. Here I've suggested it might be 3 to 10 times. Lenders, on the other hand, are only looking to get 1 time their investment. They put money in, they want to get exactly that money back. No less, no more. And managers, of course, are looking to have a continuity of income, possibly raises, possibly bonuses. So I created this column in this chart because there are implications. If we go back to the type of thinking we were discussing, where we want to understand the goals and objectives of the stakeholder, they are going to need to make some kind of an assessment about the business entity's financial position and financial performance in order to determine whether or not they can achieve these expected financial gains or financial benefits. So if they're going to evaluate the business entity, we should be able to anticipate what a stakeholder expects a business entity to do in order to entice them to do business with it. So in the case of the founders, you know, first of all, the business entity needs to survive. Otherwise, if it doesn't endure from day to day, the founder will never realize the mission and solve the problem and so on. So survival is key. Ideally, if the founder wants to have an impact, the company needs to grow. This is also called scaling up. And to stay in business, which is the survival goal, we will also need for this company to be profitable. But to achieve an increase in wealth, the company's going to need to have significant growth that's profitable. And then eventually, those profits need to translate into the generation of cash so that the company generates cash resources that it can exchange for other things like people's salaries, buying more equipment, funding marketing plans, and so on. Now, what I want you to notice from the rest of these is that there are some similar expectations of the business that these different stakeholders want. So, for example, investors, they still need the business to survive, because if it fails, they're never going to realize a financial gain. But in addition to surviving, if they want to realize a financial gain, the business is going to have to grow its revenues and eventually become profitable. And these amounts are going to have to be significant for the investors to achieve a 3 to 10 times return on their money. Lenders also need the business to survive, because if it fails, it can't repay the loan. And they need it to generate a positive operating cash flow. Now, notice that this is different from profits, although they're probably connected. But the bank loan can only be repaid from cash. And so one of the things we need to focus on is, how is the company performing in generating cash and maintaining healthy cash balances? In addition, because we discussed this morning that lenders don't take risk, they cannot afford to lose $1 on the loan. They will often have a backstop, which is a secondary method of getting repaid, in addition to the primary method of being repaid from cash flow of the business. Understand?
Yes.
And lastly, management, of course, they want the business to survive so they can continue to draw their paycheck. Ideally, growth and profitability is also a bona fide objective, because that could lead to incentive pay. And they need the company to generate cash flow so that the company has cash to pay the salaries. So what I found interesting about this chart is that there are some common themes that run through all of these key stakeholders. And the common themes are, survive, grow, develop profitability, generate cash flow. So all of these key stakeholders will evaluate these criteria for a business entity in order to determine whether or not they should engage with the business by allocating their own resources to the business. So this is a situation of mutual benefit. If the business receives these resources, financial capital, human capital, then the business has resources that they can use to grow the business, to scale it up, to become more profitable, and so on. And in doing so, the stakeholders will mutually receive a benefit, which will be returned to them in some form of cash, such as loan repayments, or a financial gain when they go to sell their shares in the company. We will focus on the course on these two external stakeholders. So the founders and management are internal, but the investors and the lenders are external. And the reason we're going to focus on the investors and lenders is because accounting information and financial statements are prepared for the external stakeholders. You remember that from this morning?
Yes, I do.
All right. So when I talked earlier about the stakeholders' thinking models and how they make decisions, this is just a graphic that tries to recap that. So we have different stakeholders like lenders and investors. It's important to understand what their objectives are. So investors, for example, want to make financial gains, whereas lenders just want to be repaid the amount that they loan one time. Okay, so those are different objectives. And the decision that the investors or the lenders make to engage with the company depends on their assessment of the company's ability, in the case of the lender, to generate enough cash to pay back the loan, And in the case of the investor, to grow the company and become significantly profitable so that the value of the business goes up and the investor can sell their shares for a gain. So those are slightly different. And when the stakeholders are evaluating the possibility of being able to achieve their goals and objectives, they're going to emphasize different business performance criteria. They'll look at them all, but the lender is going to emphasize the business's cash flow because that's what's required to repay the loan. Whereas the investor is going to emphasize the business's growth and profitability because the combination of those two items increases the business's value and the value of the shareholder's investment as a share of the business. So in order to evaluate those criteria, they have to do some analysis of information. Where do they get the information? They get it from the financial statements, as I showed you in that big picture context slide, okay? All right, so just a quick review on the two other items that you're required to know for ACC100. One is the qualitative characteristics of information. What this is basically attributes of information to make it useful for decision making. So we covered 6 of these in class. Here's the list. Do you have any questions about any of these particular characteristics?
No, it wasn't these ones. It was the next ones.
Okay. So these attributes of information are actually built into the accounting standards and guidelines that preparers or accountants use in compiling financial information for financial statements. And they form part of what's called generally accepted accounting principles. All right, so why does this matter? Okay. If information that we're going to provide to key stakeholders has these characteristics, then it will be reliable and trustworthy and useful. And so the accounting environment builds these attributes into generally accepted accounting principles, and stakeholders who are making these kinds of decisions over and over again, they are used to and trust that the information has been prepared professionally. So they rely on it to make decisions. And that's one of the things that makes financial statement information useful to the types of stakeholders that we're talking about. So what can we do with this? Well, if you are a provider of information, if you're a manager reporting to a vice president, or if you own your own business and you're providing financial statements to a bank or an investor, then you want to ensure that the information you're providing is reliable and trustworthy so that the stakeholders will use it. So you maybe had some questions about assumptions. And what I've done here is identify the assumptions that are included in GAAP with a little bit more wording, and maybe some of these will help you understand the concepts. So first of all, the financial information that we're going to report in financial statements is limited to a single entity. When we call that the separate entity assumption. So sometimes, if you decide to start a business, you might sometimes decide to start a second business. And the idea here is you want to keep those two businesses accounted for completely separately so that all the sales and costs or expenses and assets of one business are in one place, and it can be assessed based on its own information, and those are kept separate from all the revenues, expenses, assets, liabilities, and equities of the other business. And keeping them separate allows us to appropriately assess an entity's financial performance and financial position based on its own information and no one else's information. The second one is that all amounts that are reported in a financial statement use a consistent monetary unit of measure. So if you think about the face of a financial statement, and we identified 4 earlier, the statement of financial position or balance sheet, statement of income, statement of cash flow, statement of retained earnings. All amounts on the face of the statement are in amounts of money. And we want them to be in the same amount of money, the same currency, okay? That allows us to perform analytical analyses on that same data. Now, the business entity is also expected to remain a going concern, which means we expect it to be able to continue carrying on business for the foreseeable future in order that it has the opportunity to be able to recover the reported amount of its assets on the balance sheet. You have any questions about that?
No, I think when you gave us the example of the laptop, I think it made sense to me.
Okay, good. The next one, the time period assumption. The reports of financial information that we're going to give to the key stakeholders, we're going to do that periodically, which may be at least annually, sometimes quarterly, sometimes monthly, okay? And if you negotiate a loan with the bank will tell you how frequently they want to see your financial statements. But if you're managing your own business, I strongly recommend you generate them every month. In some businesses, like I used to be the chief financial officer of Kelsey's Restaurants. In those businesses, we would generate financial statements to a certain level for each restaurant every week. And that made sense because people kind of dine on a weekly cycle. You know, the retail cycle or the hospitality cycle is kind of on a weekly basis. So the reason that we do these periodic reports rather than waiting until the end of the life of a business is to help users be able to assess financial position and financial performance. And then lastly, any information that is relevant and material and has the capacity to impact a stakeholder's decision must be fully disclosed. So this morning, the way I described this was if the presence or the absence of the information would impact the decision, then we should provide that information to the stakeholder making those decisions. And again, the reason this is important is so the information provided to stakeholders is reliable and trustworthy. Now, you thought you might have some questions about the assumptions. Do you recall what your question was?
It was more of, it had something to do with the historic cost in class. I didn't understand why we picked that question, so I don't know if we can relate that here.
All right. So the historic cost assumption supports the qualitative characteristic of verifiability. And what I would say about this is, imagine that your company is buying and selling blue jeans, okay? Mm-hmm. You buy a pair of jeans for $50 and you sell them for $100. One of the things we're interested in doing is measuring your profitability. So if you can buy a pair of jeans for $50 and sell them for $100, you make $50 in profits, and you also have a 50% gross profit margin. So those are two metrics that we can use to assess your business's profit or profitability. But the way we measure profits, if you remember, it was one of those 5 primary business performance criteria. The way we measure profit, it's revenue minus expense. And what's at issue with historic cost? We're simply talking about how we measure expenses and how we measure assets, and it's at the amount that we actually paid. That's okay. What historic cost means.
So you record it as the 100.
Well, we would record the revenue at 100, but we
Right.
would record the cost of the jeans at 50.
Got it.
So that way we can measure our profit by taking the revenue, the amount we sold it to a customer for, and subtract our historic costs. And one of the reasons it might be historic is, you might have bought the jeans. Let's say you deal with kind of vintage jeans, and you shop websites, and maybe you were on eBay and you found this vintage pair of jeans and you bought them for $50. And you haven't sold them for a while. In fact, several months have gone by because you've been marketing these jeans on a different website. And eventually somebody decides to buy them. And in order to calculate your profit, you will take the price you're selling them at today minus the cost you bought them for 6 months ago. So that cost is now historic. Okay. Now, we also use this historic cost assumption to account, especially in small businesses, to account for the amounts that we present on our balance sheet as the cost of our assets, the cost of our equipment and our buildings and our land and our inventory. Okay. So that historic cost assumption, the significance of it is that's the amount we actually paid. There are other bases of valuation or bases of measurement that we could use. For example, if you have a real estate investment company, maybe they operate, let's say there's a company, you have a company and you buy a piece of land to operate as a parking lot. So you buy this land for $250,000 10 years ago. Your historic cost is $250,000.
Mm-hmm.
But the fair value of that land today is $750,000. So one issue that accountants deal with is what information should we provide to the stakeholders? Should we put this property on the company's balance sheet at $750,000, its fair value, or should we put it on the balance sheet at $250,000, its historic cost? So the accounting principle says we're going to, for a small business, we're going to put it on the balance sheet at its historic cost.
Mm-hmm.
That way, everybody knows what the property cost you. However, remember when we talked about the qualitative characteristics of information, and we said everything that was relevant to a stakeholder's decision should be fully disclosed, what we're talking about here?
Mm-hmm.
So if you bought a property for $250,000, and that's the historic cost that's presented in one of your financial statements, do you think knowing the fair market value of that property is $750, could that be relevant to any of the possible stakeholders your business might be dealing with, like a bank, for example? When I say could that be relevant, remember the definition of relevance. If its presence or absence could impact the decision. So if you're going to the bank to borrow money and you're willing to put up the property as collateral, let's say you want to borrow money to be able to pave the parking lot. So it's no longer a dusty gravel lot, but it's a nice paved parking lot with painted lines and all that. And you want to borrow $100,000, okay? If the banker looks at your balance sheet and sees that the cost of this property is $250, and you're thinking of borrowing $100, they might make one decision whether to loan you the money or not. But if you tell the bank that you just had the property appraised and it's worth $750,000, do you think that might influence the bank's decision to loan you the money?
Yes.
Okay. So where this gets us is we're using the historic cost principle, we are going to present the cost of the property $250 on the balance sheet. But we are also going to fully disclose the other relevant information, being the market value. We'll disclose it elsewhere in the financial statements. And the place we make that disclosure is called the notes to the financial statements. Okay. Now, the lender has all the information that's relevant that they need to make a decision. They have the historic cost and they have the fair value. Do you understand?
Got it.
Do you have any other questions about the assumptions?
No.
Okay. Let's go on to these critical thinking questions. So this is a framework that I like to share with students as they learn new concepts. The first set of questions is basically what, so what, now what? And what is essentially about trying to describe for yourself what this is all about. You know, you can identify it, you can name it, you can describe it, but you want to understand what's important about this, what's significant, and to whom. Maybe even how does it work? And when you know that, so for example, when you understand who the stakeholders are, right? The next thing we want to find out is, all right, now that we know that, so what? How is it going to impact me? How can I use this information? So what is going to get you to evaluate the concept or issue using an appropriate method of analysis in order to lead you to a conclusion. And so, for example, knowing that we have key stakeholders who are investors and some who are lenders, we understand that if our business needs capital, those are the people we go to. If we need a lot of money, we can either go to a lender or we can go to an investor. But now you have to decide, well, which one should I go to? And if you go to a lender, you now understand that they're going to be expecting the business to do certain things if you want to get a loan. If you go to an investor, the investor is going to want the business to do certain other things if you want to get an investment. Okay. And then the final thinking question is, now what? You know, once you understand this, what are you going to do about it? And in the example I just shared with you, knowing how these different stakeholders think and how they make decisions and what information they use might influence which one you go to. Okay. So an early stage business that doesn't have a track record is unlikely to qualify for a loan. You may have no option except to go to your parents or other friends to ask for either a private loan or a private investment. So the first set of thinking questions is just basically for any new concept, what is it? So what? How is it important? What can you conclude about its impact? And 3, now what? What recommendations or action are you going to take on this? And the second set of questions is really related to the first set. If you understand the purpose of the concept and how you analyze it, then the conclusions and insights you can develop are related to the so what question, and the recommendations and decision action are related to the now what question. All right. Do you have any other questions about what you studied in chapter 1, which includes the conceptual information or possibly any of the practice questions in the book or any of the in-class demos that we took up?
No, nothing. I'm ready.
Okay. Well, I'm glad you were able to come tonight. Thank you very much for attending. I'll try to do something similar next week, and we'll see you next Wednesday.
Okay, thank you.
All right. Bye.